Hey guys, if you're a new loan officer and you're trying to figure out how to begin your journey in lending, this video would be a perfect resource for you. If you recently got your license and you're thinking, I now have to start making money with this mortgage license, where do I get started? Then I think you're watching the perfect video. If you don't know who I am, my name is Zevi Shafran. I'm an owner of a mortgage company called Brook right here in Los Angeles. And the only thing that I ask is if you enjoy this video, please give it a thumbs up so other people like yourself can find this information on the internet. And with that, let's get started. Just like any other business in the world, you gotta be a good marketer. No matter how great you are in your business, if the world doesn't know about you, then you're not really likely to earn a living. Right off the top is to be a really good marketer, right? I guess the first question is, what kind of marketing would work best for somebody who's in the mortgage business? Being proactive, and what do I mean by that? Being proactive in the mortgage space means that you're consistently reaching out to people that are going to be considered your referral partners, and at the top of that list, that would be your real estate agents. And the reason I say that today more than ever is simply because of the lending environment that we're in today. In today's market, which is January of 2025, there are a lot more purchases than any other transaction. And so you got to take a step back and ask yourself, who is controlling the purchase market? And the people that are controlling the purchase market are the realtors, right? And so your objective should be to try to get in front of 20 to 50 real estate agents every single day. And by doing that, you're going to start seeing some results. And if you're not seeing the results that you want to see, then that means that you have to do more of the same thing. You're marketing yourself by being proactive to real estate agents, which control the purchase market. They have the buyers, and you're trying to do somewhere between 20 to 50 outreach a day, a combination of email, text, phone call, video. Now, there are other forms of outreach. You might be thinking, hey, Zevi, I'm watching this YouTube video right now. Is this a form of outreach? It absolutely is. But what you have to understand is that when you post a video like this, it's very broad, right? Just like if you get a generic email, it's very broad. Versus if somebody texts you directly or emails you one-on-one, they have your attention. Most people check their emails multiple times, I would say within 10 minutes. So if you're trying to reach someone, and I say that because when you're trying to solicit real estate agents, you're not soliciting every real estate agent, right? Because as an example, just in Los Angeles, there's 120,000 licensed real estate agents in the city of Los Angeles. And so a better way to do this would be to go on platforms like Zillow and realtor.com. What you can do is identify the zip codes or the geographical areas that you would like to work, maybe the areas that you're closest to. And you can easily pull up the people that are the top producers in that space. Now, ideally, the people that you will want to work with in the beginning are not the top and are not the bottom. They're people that are somewhere in the middle, because it will be a lot more difficult for you to try to crack into people that are top producers at this point. And people that are at the bottom are just not gonna do a whole lot of business, if any, so they're a bit of a waste of time. So what you're trying to do is crack the people that are somewhere in the middle to give you an opportunity to get a transaction under your belt. Now, I'm not discounting social media by any means. I feel like whatever it is that you could put your time into and stay consistent with it is wonderful. I'm just saying, if you wanted to see immediate results, the quickest way of doing it would be to infiltrate the real estate community and start building connections. All right, so that's step number one. Now, you might be asking, okay, now that I was able to infiltrate this community and maybe get an opportunity to get in front of a few people, what would be the next thing? What should I be talking to them about? Here's the deal. Most real estate agents, they have very limited knowledge of loans. There are basically three categories of loans that you can mention to them. They're not going to know a whole lot about either one of these buckets, but you can let them know that you either do conventional loans, which are the type of loans that banks do with tax returns, or non-conventional, which are also called non-QM, also subprime, and then there is hard money, which is basically anything that doesn't fall into this bucket or that bucket. All right? So just so you know, these loans are also called agency loans, and if they're past a certain limit, they fall into a bucket called jumbo. Right over here, non-QM, also called alternative documentation, non-qualifier. And then hard money is also known as private money, deed of trust investors, or debt funds. Now, you don't really need to know a whole lot about any one of these just to strike a conversation, because the truth of the matter, most real estate agents are very social people, and all they're going to want to know is that you have an idea of what this is and that you can help their clients. When you have an opportunity to get in front of a client, say you have an opportunity to do an open house, right? Then what you would need to know how to do is basically size up a borrower into a payment. And that would help you understand if they can actually afford a property. So as an example, say you met with a real estate agent, you got an opportunity to go to an open house with them, right? Clients were able to walk in, this would be your next step. And you want to know how to do this so you don't waste your time and you look like a pro to the real estate agent. So ideally, let's just say you're sitting in open house, it's $800,000, right? And so what we would want to know, what would be a down payment on something like $800,000? We're just going to use some basic numbers. Let's just say that it's 20% down. All right, so that means it's $160,000, which means the loan amount here would be $640,000. All right, so $640,000 would be the loan amount. That means that this is a mortgage payment of right around $4,000. I don't have a mortgage calculator next to me right now. I believe it's a little less. I think it's probably around $3,800. All right. And the reason I'm doing this, property taxes on something like this, probably another $800. They're about 1.25%. And then insurance on something like this is maybe like, I don't know, maybe $200. It's something like 0.3%. And the reason I'm doing this, so I'm right around 48, let's just say $5,000. All right. And so the reason I'm doing this is because if I'm sitting in open house with a real estate agent and somebody walks in and says, yeah, I want to put down 20%, this house, I could get a loan for $640,000. I know that the payment is right around all in property principal, interest, taxes, insurance, about $5,000. You should know that the highest qualifying ratio is 50%, which means that if the payment is $5,000 all in, and I don't know what other liabilities they have on their credit report, then that means that times 2, right? Because this is 50%, so 100%. The borrower would have to make a minimum of $10,000 to qualify before any other liabilities. This is a quick way of us having a conversation with somebody and being able to size up a deal and not waste anybody's time. If this borrower says, yeah, I absolutely make 10,000 and more every single month, then this is where we take the next step in the journey, all right? And so the next step in this journey would be you taking a formal loan application. And when you take a formal loan application, for the most part, you're looking for the following. There's the basic info, right, which tells us who this individual is. There is the employment piece, which tells us where they work and how much income they make from this particular job. There is their assets, which also includes their liabilities, but we are not worrying about their liabilities because we're going to pull that in from their credit report once we run credit. And then ultimately is their, we're going to call it REO or SREO, Schedule of Real Estate, okay? So we have basic info, employment and income, assets and liabilities, and Schedule of Real Estate. That's basically everything we're looking for in any type of loan application, no matter what software you're using. Your liabilities are going to be pulled in from pulling somebody's credit. And as a matter of fact, when I initiate a transaction, the first thing that I do is I pull up something called borrower authorizations. And it's actually, there's a link to the borrower authorizations available on my website because it allows me to pull their credit, communicate their information with a lender or with a third party. It allows me to do everything I need to do with authority from the borrower. So that should be something that you definitely do. Once you have this information, all right, then there's typically a standard needs list of items that you should be requesting from the borrower. I have checklists. I'm just going to name it checklist, okay? Checklists that are actually listed at the top of my website. So what I do is I literally copy and paste the URL and I send it to my borrower so they can go through the checklist, whether it's, because we do residential and commercial lending. So I have a residential, commercial, construction, hard money, and literally just send them that checklist of items so I don't constantly have to repeat myself about what it is that I need. For you, you can also create a template of the items that you need. So in theory, for any transaction, you typically need assets, right? Because they listed their assets, but now we need verification of their assets. Same thing with their employment and income, right? So now we need to verify these items. And for their SREO, Schedule of Real Estate, same thing. We would need the mortgage statements, the insurance, the lease agreements, anything that's associated to the actual property, all right? And now, those are the basics of it. If there's things outside of the scope, example, things that people use to supplement their income that you might not know about, they might even not be taxable income, so you might not even see them if you do request a copy of their tax returns, like pensions as an example, child support, right? Different things like that. Those are things that you can keep in the back of your mind. Also, if somebody has a ton of money and they don't show a lot of income, you could use something called asset depletion to qualify them. Another pro tip for you, all right? Once you have all this information put together, what I personally do is I don't like to have a lot of personal information go back and forth via email. So I actually send them a secure link. And this link allows them to drag and drop their information into the link. And then this way I have access to it. So imagine like a Google or a Dropbox versus them emailing me all their information. It's also encrypted, which means that their information is now secure. It's a lot more safe than just sending an email. Once we have all this, your next job is to take this file and hand it over to your loan processor. Okay? In theory, you should step outside of this transaction at the moment and let your loan processor take over. Mind you, that little exercise that we did, saying that the borrower is qualified based on the income and the proposed debt, it does go into a lot more detail, which I'm not going to cover in this video. And the reason I'm telling you this is because when you give the loan processor the file, you've already had the opportunity to glance at the income and make sure that it should work, because their job is to check your work and make sure that the income does in fact work before they take it all and disclose it to the lender. All right, so now it really depends on where you work. If you're a wholesale mortgage broker like myself, then you actually get to pick the lender that you want to work with. And so what your loan processor will actually do is they will take the 1003, which is the mortgage loan application, and they will upload it via point file, right? It's called a point file for us, point file. And they will take that file and they will load it to whatever lender we decide to work with. And then there will be other questions that we will answer to make sure that we disclose the file. As soon as we do, the borrower gets notified electronically that they need to go in and acknowledge a few things, one of which is that they agree to acknowledge documents electronically. And then secondly, there's going to be a stack of documents coming to them, specifically their initial loan disclosures that they would need to acknowledge so we can move forward in the transaction. There are two pieces of information that are super important for them to acknowledge. And the first one is the intent to proceed. That means that they actually know that they're getting a loan and they agree to move forward. It's called the intent, right? The intent to proceed. And the second one is the LE, which is the lender's estimate. It's just a framework of what the charges are going to be. Now, they may look at it and say that it's more than what they thought the charges would be. And this is where your job as a loan officer kind of comes into play, because there's two sides to the lender estimate. The first side are the actual costs, and the second side are the actual prorations for the most part, okay? And what I mean by here is lender escrow title, and what I mean by here is recording fees, proration of interest, taxes, property taxes, insurance, all the things that they would have to pay for anyways, except the prorated through the transaction. And so that would be your lender's estimate. Once they acknowledge both, then the processor goes back into the file and actually loads in all their physical documents, so the file can be pushed into what we call underwriting. And in underwriting, the lender makes a credit decision about the file. And ideally, you would want this file to get conditionally approved, all right? And when something is conditionally approved by an underwriter, remember, you don't make a credit decision as a loan officer. Your processor doesn't make a credit decision. The underwriter, okay, underwriter, is who makes the credit decision. And so once the loan is conditionally approved, then there's going to be conditions that the borrower needs to meet, so this file can be fully approved, all right? And once the file, of course, is fully approved, then the file goes clear to close, and that's called CTC. You might hear this from your real estate agents because that's one of the only terms that they know. Respectfully, of course, they're not loan officers, but they know this because they push to clear to close every single transaction because they know that that's basically when the file goes from underwriting to closing. Okay, so that means that over here there are no more conditions, which means that the borrower, in theory, you never let a borrower know that they can sign off their financing contingency, but you could let them know that the file is out of underwriting and has moved to closing. That's basically the only thing I can let the borrower know, and then they can make whatever decision they want, knowing that their loan is now going to be moving to closing, all right? So that's the general idea behind the transaction itself, and then once we're in closing, then depending on what lender you're using, and I say that because if you're using a lender that table funds, then what happens is once the conditions are cleared, then the escrow and the closer basically communicate with one another to balance, and then your loan is on autopilot to fund. If you're using a non-QM lender, which we were talking about earlier, like the subprime lender, right? Then what happens is you get the loan docs signed, they get back to the lender's office, and then they assign a closer who goes through the closing conditions with the escrow officer, and then they coordinate a time for the file to fund. And in Los Angeles, we typically fund and then record the following day. It's just the way it is, all right? So hopefully you got a bunch of really good information from this video. I kind of just wanted to touch on the journey. I think the most important part is just marketing, being consistent with your marketing, because at the end of the day, that's basically where your deals are going to come from. Once you package everything well, it's going to go to your processor, and then you will eventually learn the journey from there, all right? If you have any questions, please don't hesitate to drop them in the comments below. For me personally, I've done both residential and commercial lending for many years, and what I found is that residential lending is great, but to be able to elevate your skill set as a loan officer, I would highly consider learning about commercial lending. Last year, I developed the Part-Time Commercial Lender Academy, and it's available for you via link in the description of this video. And it's basically an academy, a roadmap that is super easy to follow, plug and play, that can walk any loan originator through a commercial lending transaction and earn you a lucrative commission, all right? So if that's something you're interested in, basically it takes residential lending and plugs you into commercial lending, giving you the ability to fund much larger loan amounts. And as you raise the bar higher, kind of like a pyramid, right? It becomes skinnier at the top. So you kind of narrow out all the competition. You become a lot more of a specialist. What I love about it is the fact that you could actually participate in deals with other loan originators. As long as they have a licensed company, you could write them into your term sheet, and that would be highly illegal to do in residential lending. So there's a lot more opportunity in commercial lending. You could do it nationwide, and the commissions are a lot larger. But I do love both residential and commercial lending, and if you're getting started, you're not sure which one, then feel free to check out the Part-Time Commercial Lender Academy and the link in the description, all right? With that, I appreciate you guys. Thank you for being here. Thank you for watching this. Again, any questions, drop them in the comments below. Make sure to hit the like button so other people like yourself can find this valuable information on the internet, all right? I appreciate you guys, and I'll catch you again on the next video. Take care.